everyone, welcome back to the channel, your number one source for income-oriented investing. Speaking of number one sources for income-oriented investing, I got a uber super special guest today, Stephen Bavaria, author of The Income Factory. Finally, and what I like to call, I think, there it is. Yes, I think I like to call you, typically refer to you as the godfather of income investing. Most probably you are the godfather of it. So Stephen, how you been? Thanks so much for doing this. I really appreciate your time. How are you doing today?
Thank you. I'm doing fine, and I'm delighted and grateful that you invited me on. And what
I
you
am
do
grateful.
is
I'm the
fascinating.
one who's grateful. I'm very excited to speak to you.
Terrific.
So yeah, you flashed your book there. So just in case, my community, we have a community of 14,000 people in Facebook group. We have our online community. So just in case some of my community members and watchers don't know you, just tell me a little bit about yourself and your background, if you will, if you
Sure,
don't mind.
sure. Well, I started out about 50 years ago as a banker. I worked for the Bank of Boston, which, like so many banks, is gone now. But I did credit workouts. I learned about credit. I had gone to college. I'd gone to law school after college while I was working, thinking I might want to go into law, and I never did. But I graduated and then got into loan workouts, where there's a lot of negotiating, and you hire lawyers to help you collect money from corporations that have gone bust or whatever. So I spent a number of years traveling the world, living in Panama, Australia,
Where I
owning.
live now, yeah, we talked
Yeah,
about that. What a crazy coincidence.
yeah. But so I learned a lot about credit, which is, especially getting your money back from companies. And that was fascinating. And then I had a kind of midlife crisis job where my banking career ended. I was in my early 40s, went back to school and studied journalism at NYU in New York,
Interesting.
and and then actually took a job with a magazine called Investment Dealers Digest that wrote about finance and Wall Street and that sort of thing. So there I was as a sort of 42-year-old cub reporter working with all these 25-year-old cub reporters. It was one of the neatest experiences of my life, working with all these young people. And I brought more experience. They probably knew more about journalism, many of them. They'd been at it a few years. And so I ended up writing about credit and
Mhm.
about Standard and Poor's and credit ratings and all that. And then fortuitously, I was offered a job at S&P. So I went over there and then had another 18, 20-year career in credit from the credit rating standpoint. And that was fascinating. And I'll tell you later, this all came together in my whole approach to income investing. But what I found was that um, bank loans, what we used to call bank loans, senior loans to corporations, which were almost always made by banks in the old days. But banks would hold them on their own books until maturity, so they didn't need credit ratings because they weren't being sold to public institutional lenders, institutional investors.
Mhm.
But they were starting to be. This was in the mid '90s. I was at Standard and Poor's, and I'll never forget. Uh, I went to a conference one day, and somebody asked one of the people how they priced bank loans, and the guy made a joke. He said, "Oh, they price them all this. We price them all the same, 200 basis or whatever he said, 300 basis points over LIBOR," and everybody laughed. And then I went back to the office, and I thought, he's telling the truth. And you've got all these loans being made by bankers who aren't thinking in terms of credit rating, ratings, because they're not public. They're not used to doing that. They're used to just doing a evaluation. Will this company pay me back or won't it? Kind
Right.
of yes, no. And so I realized there were triple B companies and single B companies all paying the same rates, for their loans. So somebody was always leaving something on the table. Either a borrower was getting a better deal than they deserved, or a lender, an investor, was getting a better or worse deal than they deserved. So I
Right.
went back to S&P and I said, "Hey, we should be rating these things." And I thought they'd jump at it. "Oh yeah, let's do it." But like any organization, yeah, you're the new guy. What do you know? And we've never done that before. So it took me a little while to convince them. And then I also realized that traditional corporate public ratings just rate whether a company is likely to default or not, because most corporate bonds are unsecured. And, so all you're looking at is the corporation going to pay or isn't it?
Yeah.
With bank loans, with what we now call senior corporate loans, the kinds that we invest in and that business development companies make, that kind of thing, they've all got collateral for the most part. And they're structured in a way that even if they do default, you're going to get your money back, or at
Right.
least some or most of it back. So I realized we had to rate not only the default risk, we had to rate the loss in the event of default, risk or prospects. So it took a while, but this became actually a big business at Standard and Poor's, and I kind of rejuvenated my career a bit. And
Excellent. Well, you had a good
yeah,
idea because, yeah, I mean, now it's starting. The more I hear you talk and hear your background, the more it's starting to make sense what kind of stuff you like, you
oh,
personally. But we'll talk that we'll definitely
yeah,
talk a
we'll
lot
get
about
into
that
that.
later.
But it also, you're familiar with collateralized loan obligations, the
CLO, yeah.
CLOs, that they have now become, they're the sort of what they call securitized vehicles, the same sort of vehicles that buy, mortgage loans and student loans and, appliance paper, financing. You can take all kinds of debt and put it into these securitized vehicles, and then they get leveraged 5, 6, 7, 8, 9, 10 times. And so anyway, CLOs needed ratings. You can't have a CLO
Hmm.
if you don't have ratings on what it's buying. So by putting ratings on loans, it enabled all of this, new business by institutional investors of different kinds to now start buying these things, and that's how the loan market became at least a quasi-public sort of market. So anyway, that's what I did, and then finally I retired in my early 60s. But I kept on writing. I'd been started to write for Seeking Alpha. I'd always enjoyed writing, and so that became my main thing. And like you with your early YouTube videos and things like that, I found, gee, I could leverage what I enjoy doing as a writer and maybe even help a few other people and make some money in the, if I turn it into more of a real publishing gig, which is what I've done at Seeking Alpha. And now I'm so grateful to all the members, as I call my subscribers, because not only do people ask me questions, I'll answer some of them in our chat room, besides doing all the articles I do for the members. But now the members answer each other's questions, and
Yeah,
it's
that's what's
a
happening to
real
me too. That's
it's
what's
been a
happening in
really
my.
helpful community. I think of it as, people over the back fence explaining, comparing notes and ideas and chatting in the neighborhood,
Yeah,
with each other. So
yeah,
it's
it's a
become
phenomenal
really a
thing to
wonderful.
watch. It's
Yeah, it's been great.
it has been great. Yeah, it's an honor because you're like, you know what, I'm helping people. At the beginning you're gonna have people ask you questions, and then they'll learn, and after a year or two go by, you go back, and now they're answering other people's questions. It's pretty cool to
Hmm.
see that. So yeah, thanks for that summary. I greatly appreciate. Obviously, you have a lot of experience, especially in the field of fixed income loans and debt, which is an absolutely humongous market in the U.S. Canada, not so much. We don't have many of these products like closed-end funds that have all of these debt instruments, whether it's mortgages or high yield corporate bonds, investment grade corporate bonds, and government bonds, and aggregate, whatever. There's a million of them. Canada's a little bit more muted with that. There's not much of a market there, but in the US, there's hundreds and hundreds and hundreds of closed-end funds, even all-in-ones, and we're going to talk about that later. First, I
Yeah.
want to talk to you about your book. So you came out with the Income Factory. What would you say is the main premise, the main psychology behind the Income Factory? What is the Income
Sure.
Factory? What is the mindset of income investing?
And how I got into this. Actually, the book came out, it's been about 5 years now, although the basic philosophy is in the book. And I'll give people a secret. If they read the introduction and chapter 2, they'll have the guts of what an income factory strategy really is all about. And I'd have to say I understand it better now than when I wrote the book. Now that I've got whatever I've got, 17,000 followers on Seeking Alpha, and we've got over 1,200 or so actual subscribers. And my little inside the income factory on Seeking Alpha has become the 12th largest of 150 or so subscriptions. So it's really grown. And where it all got started was I've never claimed that an income factory or an income approach is any better than just going and buying an equity index fund and just sitting on it for 20 years, 30 years, 40 years. I've often said
Same.
Rip Van Winkle would have made a great investor. He'd have just gone to sleep and let it grow. But what I understand better than ever now is if you look at
Yeah.
total return is what every investor, if they're rational, should be striving for. And if the average equity return, we all say, you'd like to make an average equity return which would be 9 or 10% over the
S&P
past
500 average annualized.
century.
Yeah,
If you go
9,
back,
10, 11.
that's right. Not It's been better than that for the last decade, but if you
True.
go back to 25 or 30 years since SPY itself was
Yeah,
created, it's around 9 to 10%. And what I understand even better, I started doing it before I fully understood it. In other
same
words, I
here.
understood it in a right-brained way, but now I understand it even, equally in a left-brained way. If total return is both the cash you received in dividends plus whatever the capital gain or loss is in your portfolio during the time you're measuring, then if you want to make a 9 or 10% total return and you want to make it year after year after year and just compound it and grow it, if you're in an accumulative stage of your life, like most people between 25 and 65, actually, because even a 65 who's thinking of retiring may live to be 90. So they've still got to invest with a bit of a long-term outlook. But you can earn that total return with stocks like the S&P 500. You'll earn a 1.5 to 2% dividend, and you're betting that you're going to get another 7 or 8% on average year after year after year to get you your 9 or 10%. Well, if you invest in high yielding assets that pay you
Nine, the
7, 8,
9%. Yeah,
9%. It's going to vary over time because
right.
the underlying base rate, the zero risk, base rate on which you build a credit spread, that's going to vary from almost zero 10 years ago to now, to a more normal 3 or 4%, maybe 2 or 3. So anyway, if you can earn a yield of 7 or 8 or 9%, and currently even more with certain kinds of investments,
Yeah,
then if you have no capital gain, if you compound that, you've got the same total return as somebody who's just getting a yield of 2% and getting that 8% capital gain. But the difference is, and this is where it all becomes psychological more than financial.
that's what I want to dig deep into.
Yeah.
The
Many of
advantages.
many of us, myself included, are not really. I don't have the iron will to sit there with all my money in an S&P index fund, let's say, and hope and know in my mind that, okay, if I leave this alone for 10, 20 years, it's going to do fine. But during those years where it's dropping instead of rising, where all I'm getting is my little 1.5, 2%, you can get a little stir crazy,
Yeah,
and that's really angst, a lot of stress. And that's when the typical person, not everybody, a really iron-willed long-term type will just sit right through it, knowing that maybe in next year or the year after they're going to make 12 or 15% to offset the 5% they lost this year. But if you have an alternative where every year you're cranking out 8, 9, 10% yield. Now you got to pick the right stuff. And that, I'm not claiming I'm omniscient about picking the right stuff, but there are things out there. If you look historically, there have been funds and others that have earned 7, 8, 9% or even more for many years. You pick the right stuff and you kind of manage it carefully. You can collect that cash all the time, which really lets people sleep a lot better
yeah.
than if you're worried that, oh my gosh, I'm down 5% on paper, and you're trying to, gut it out and not want to sell or hedge or do things that people often do. They think they're going to do better, but they end up doing worse on average. So for me, it was realizing that I'm not saying either one's better, but when I started writing about this 10 years ago on Seeking Alpha as my own portfolio, I found myself shifting it more and more to higher yielding stuff and realizing that, hey, it's compounding and doing just as well, but I'm feeling better. You know,
Yeah,
in the early days, I had people arguing about the basic premise. They would say, no, if you're 25 or 35 and you want to grow, you've got to have growth stocks. You could never do it with income stocks, high yielding stocks. And I would say, no, I'm not telling you I'm better than what you're doing. I'm just saying
just
that
as
the
good.
two, in theory, yeah, I mean, math is math, as
Yeah,
you sometimes say that, 10% plus 0% or 2% plus 8% or 5% plus
same
5%, it
total
all
return. Yeah,
adds up to, the same total return. And once you buy into that, then you also begin to realize that during down markets, if you're owning high yielding assets that are producing what I call the river of cash constantly, regardless of whether they have paper gains or
Losses.
losses in a
Right.
particular year.
You're still
When
getting
they
that
have
cash flow.
losses,
Yes.
you're actually reinvesting at bargain prices. So, like in 2022, when the market was way down, I actually grew my income faster than I
Yeah, of
would
course. You're buying
in
cheaper
normal
units.
months because I'm compounding it at a higher yield. And so once you begin to understand that, and now I've got all these people who read me, and all the time I have people saying, "Wow, I'm sleeping better at night. I understand this. It's not so crazy. It
Yeah,
just."
it really is, and
Um,
I get that all the time as well. There is a learning curve. It's
mm,
more, I would say, it's more of a newer style of investing. It's not a classic style, which is just by the S&P hold them forever. But you touched on that really big advantage that I feel is probably one of the biggest advantages to income investing. You said I sleep better, you sleep better, and it is
mm,
true. The thing is for me is you never have to sell your assets. If you
that's
think
right.
about that, that is the biggest advantage, because you're always making that 9, 10, whatever it is, that yield. Your capital could go up and down, but you never have to sell that asset, unlike someone who's holding growth stocks or an S&P, where, you could also say, yes, I never have to sell my assets, but you do have to draw down. You can't really live off, unless you have
Well,
50,
that's it.
$100 million off 1% yield. So every year, every month, you have to sell a little bit off. But what happens if there's a crash? You got to sell at a loss. That kind of sucks, right?
Oh, I did an article, not only for my own subscribers, but a Seeking Alpha kind of public article just last month, pointing out that while the two approaches, index investing or growth stock investing and the income factory, while they're basically equivalent and good alternatives while you're in an accumulative mode, and once you hit a retirement age, whether that's 60 or 80 or whatever it is for you, where you have no choice but to start taking money out
Yeah, draw
regularly
down.
month
Yeah,
to month. That's right. That's when you get into, I guess, what they call the sequencing risk, where if you've got to take money out each period
yeah,
and the market's down and you've got a stock portfolio, then you've got to sell stock when it's down.
yeah.
Whereas as you just pointed out, with an income factory or an income, high
You
yield
don't have to.
portfolio, if you're earning 8 or 9% every year and you have to take out 5 or 6% without fail, well, you can take it out and you still have 3 or 4% left to reinvest, even if the market's down. So while the two I consider all equal alternatives, at a certain point, once you retire and are in a distributive phase where you're taking it out, then actually I think the income factory approach, whatever you call it, I call it income factory because it's clever, and I'll tell you about that in a second. But that really becomes a better approach for people that are retired. I think it actually is a safer, more prudent approach.
Yeah, I also, yeah, so you touched a lot on the benefit. You and I are going to get along real great, my friend. We're on the same page 100% in terms of psychology of income investing. I just think we kind of use different vehicles to get there,
Mm,
but which we'll talk about,
sure.
but everything else is the same, the psychology. So you touched on a lot of advantages on benefits. You don't have to worry about the drawdowns. You never have to sell. You could, that's why I always say I'm always looking forward as an income investor to a down market. That's the best time for me. Like you said, you've increased your cash flow a lot during that time, even more so than a rocketing market going upwards. That's the best time for an income investor because you get to buy more shares at a lower price. And even if you're living off your income, you could, try to reinvest. I always, rule of thumb, try to reinvest as much as you can. But even if you're reinvesting a little bit, you're still capturing those cheaper units, which is literally increasing your monthly income. Never have to worry about recessions or anything like that. In fact, you look forward to them. What do you
Well,
think of that?
I would say I was just thinking that if the markets go up and down for various reasons, if markets are going down, just because something happened that causes people to be pessimistic or whatever, markets can go down for a lot of reasons. Now, if a market's going down because there's a real honest to goodness recession, bad recession that's going to cause defaults to increase to a level where it actually will affect your river of cash, where your river of cash coming in might actually, distributions might get cut, that sort of thing. That's to be expected sometimes. And if they only get cut a little bit and you're earning 7.5% instead of 9%, I can live with that, especially if
That's
I'm
where,
reinvesting.
yeah,
But if
that's where
it's a real,
fund selection comes in. You have to
that's
select
right.
during the time
Yeah.
of your life. You know, if you're 65, 70, you're drawing on this income, maybe you'll have to switch your fund selection and go a little bit more conservative. And you know, and that's where you have to analyze the fund, the history of the
Mhm.
fund. How is it making its money? Has it reduced cut distributions in the past?
Mhm.
What is that cash flow dependent on? That's where you have to do a little bit more digging. But I agree, it might not always be perfect. Sometimes there could be reductions. But
Yeah.
hey, I'd rather take a reduction in my cash flow than having to sell when the S&P is minus 20% or something like that.
Well, that's right. And I haven't done an article about this for a while, but you start thinking through, say you have a whole portfolio of funds and in different
Yeah,
asset classes, and you start projecting, okay, well, what if the worst were to happen, whatever that would be? What if 25% of my funds had to cut their distributions by 25%? I
yeah.
mean, well,
Yeah,
25% times 25% is what? 6% or something, something like that, So, and then you think the conditions that would cause that to happen, where I would lose 6 or 7%, my income would drop by 6 or 7%. Well, those conditions would probably cause an equity portfolio to do far worse in that environment. So all of this is
oh, for
relative
sure,
to
for sure.
what's the alternative, unless you have enough money, and I don't, to just invest in totally safe investments all the time, and just make 3 or 4% of my
Yeah,
money.
government bonds or something
Yeah,
like that. But you need like $50 million to generate,
that's right.
10,000 a
That's
month, which most people
exactly.
need.
So I'm writing for people who are looking, who need to invest their money and create an income. And then
Yes.
it's a question of, okay, what's the more prudent way to do that? And which way is going to allow you to feel more comfortable, whatever your risk reward sort of comfort level is, and
Yeah.
that sort of
Yeah, but see,
thing.
the thing now is my personal opinion is I think we're entering in a golden age of income investing. We're going to talk about this a bit later. I just want to still stay on the psychology, even though we covered a lot of it already. I have to check the
Yeah.
questions, but
Mhm.
I could probably talk to you all day about this. But now there's starting to be, and I discussed this earlier with you, covered call ETFs. So that's my
Mhm.
bread and butter. That's really what I focus on because I feel like, and we discussed this, stocks or equities long
Mhm.
term is the highest performing asset in terms of total return. I think we could all agree on that versus fixed income versus cash, obviously. So now I think there's a golden age because there's been an explosion of, and we discuss index funds, S&P 500, NASDAQ 100, Russell 2000. I believe, in my opinion, index investing is literally the best way to invest long term. It's the easiest, it's the lowest cost, it's very, very, the average is, now it's a bit higher, it's maybe 12%, but the average of the S&P is about 9 to 10 a year annualized. Of course, there could be years plus 20, there could be years minus 10, there could be years zero, but over the long term, the average. So I think equity investing is the best long term in terms of returns. I also think index investing is awesome as well because you automatically have the best companies, right? You buy an S&P, you buy a Nasdaq 100, you automatically have the big cap companies and they're rebalanced. You work for S&P, you know what they do. They rebalance it for you. They're very low cost. So now I feel like the golden age has started for income investing because you could literally buy an S&P, a Nasdaq, Russell 2000 covered call ETF, which kind of turns that growth vehicle into an income vehicle. Of course, there's different styles. Some people write a lot more covered calls, less covered calls, daily
Mhm.
options, monthly options. It's absolutely exploding now. But in Canada, it's over a year now that there's been these. For example, I'll take an S&P 500 with covered calls, and then they add 25% leverage. So
Mm.
you get an annualized yield of between, let's say, 12 and 13%, and the total returns are similar, if not a little bit less, and there's in some cases a little bit better than the index itself, the passive index itself. So I think for me as an income investor, that is the best income vehicle right now.
Mhm.
So yeah, I mean, I think we're income investors. It's much easier being an income investor now than it was even when I started in like 2018, 2019, because these things didn't exist. Now they're exploding. The US is exploding too. You got daily option cover call ETFs where you're buying equity, you're buying the S&P or the Nasdaq, but you're kind of made into a cash flow asset that you could kind of live off of and make a nice yield. So,
Mhm.
any comments on that? Be,
Yeah, even questions. The idea. I haven't done covered calls myself. I invest in funds. So when I invest in
closed-end funds, mostly, right?
mostly closed-end funds and some ETFs, so the covered call investments I've made so far have been through closed-end funds. Like Eaton Vance has quite a
Yes, they
few.
do. There are
Well,
covered call closed-end funds. Yes.
that have done, yeah, and then there are a few others. BlackRock, I know. Anyway, and to the extent that I understand it in theory, broad terms, this idea that you're trading off potential growth,
Upside, exactly.
yeah, in order for, to then create a continual sort of cash income by constantly trading off the, next month's growth or whatever
Yeah.
period of going out. To me, that just intuitively makes a lot of sense. And what I've often thought, but I haven't had somebody like you to ask actually, so I can turn into the interviewer here too.
No problem.
Um, uh, the idea that you've got ETFs doing these, as well as say closed-end funds like the Eaton Vance. Eaton Vance has been doing it for so long and has such a history. And I've wondered, are the ETFs as actively managed, say, as an Eaton Vance or one of the others, or is it more of an algorithm-driven sort of thing? And is there an advantage to having a real portfolio manager who's doing this for you? I mean, that's
Most,
my
yeah. So
first
there,
question.
yeah. So they are most of them are actively managed, or
Mhm,
but there are some that have what I like to call a rinse and repeat strategy. So, for example, the most popular one or the most old school OG one is the Global X QYLD, right? I'm sure you've heard about QYLD. I'm sure many
QILD, yeah. Mhm,
QYLD. Yeah.
sure.
So what that's a perfect example where they actually write an at the money covered call on the whole portfolio. So they're literally giving up all the upside of the NASDAQ 100 to get this
Mhm,
massive premium, which is typically 2, 3% a month. And what they do is they give out 1% in distribution and the rest they reinvest it for you. So that's an example where it's a rinse and repeat, where you're, like
mhm,
you said, they use an algorithm, the same strategy, but those actually tend to underperform. Now there's more and more actively managed ones where there's more advanced options, capability. Some of them do call spreads. Now there's daily options, and but the general premise is exactly that. You are giving up a portion of the upside of the index or of the underlying asset, because you could write cover calls on anything, on a single stock, on a group of stocks, or on an index. But the general premise is the same. You're giving up some upside, but the amount of upside depends on the strategy and the fund manager. This is where you need to do a little bit more digging. So the general rule of thumb is if you see a very, very, very high yield, they're probably giving up more upside because they're
mhm,
writing more covered calls. But some of them, give out a consistent 8, 9, 10% yield where you're not giving up much upside and they're pretty much keeping in line with the actual performance of the index itself. And in one particular case, this is the first time it's happened in covered call history, I believe. There's a NASDAQ and a S&P 500 covered call ETF that uses zero DTE or daily options, options that expire daily, which is brand new. That's actually beating the S&P 500, beating the Nasdaq 100. This has never happened in the US. In Canada, there is a few that's doing it, but it's more of a classic cover call strategy, but they have 25% leverage. So I
mhm,
feel like the
mhm.
next step in the US, the next big thing, and I know it's going to happen, we're going to see, just like we see leverage closed fixed income closed end funds or equity ones as well. Eaton Vance has a bunch of equity
Yeah,
closed end funds as well, not just fixed income.
sure.
BlackRock does too. They have technology, healthcare one. I think leveraged covered call ETFs, and not a lot, just, in Canada, we have 25%. This is not a lot of leverage.
Mhm,
That's going to be the next step where you're going to get the same performance as the index, but with that monthly cash flow, which for me is the holy grail of income investing, because I want that cash flow
excuse me.
without giving up performance that the index gives. So only now have we starting to see these breakout funds that could actually accomplish that.
Well, some of the funds I've noticed here that have gotten a lot of attention, maybe that seem to pay yields, at least for certain periods, that are like off the charts. And I think they also pay like monthly dividends. Are you talking like the like
So
XDTE and QDTE
those
are
are the two that I'm referring to that they're beating the indexes, which I never
yeah.
thought possible. So The MER is 95 basis points. What's IVV's basis point? Three basis points. So it has much higher yield, a much higher fee rather. So and they have weekly dividends. That's what's also very special about them.
Mm.
They're weekly distributions, but they vary enormously because the distributions are based on option premiums, which is based on volatility, which varies. So
Yeah.
sometimes, but on average, I would say you're looking at between 20, 25 on the lower end and maybe 30, 35, maybe a bit higher on the higher end of yield,
Hmm.
really in terms of raw yield. But that, like you said at the beginning, right? It's the yield plus the capital equals the total return. You can't just say,
Yeah.
"Oh, I'm buying a fund that has," there's some funds that actually have like 90% yield.
Mm.
But the capital is on a decline, so you have to do 90% minus the capital decline.
Sure.
You know what I'm talking about. But yeah, those are the funds I'm talking about. There's more and more that are coming out. So obviously, JP Morgan's the biggest in the game right now on the US side. They have JEPI and JEPQ,
Happy.
Nasdaq, and an
Yeah.
S&P, or an S&P, and Goldman Sachs has joined the game. Invesco, who invented QQQM, now has their own. There's Neos, the one you talked about, QDT, XED, that's Roundhill. There's
Yeah.
Defiance, and there's probably a few others that I'm forgetting. So there's a lot now in the US that are all, you're buying the S&P, you're buying the Russell, you're buying the Nasdaq 100, but they're all doing a different style of covered call writing on them. And depending what the market does, some will outperform others, right? If the market's down or flat, the person who's writing more covered calls is going to win because there's no upside. But during a rocketing market, that's where you're giving up a lot of upside. But if a manager kind of like Goldman Sachs is doing always out of the money calls, you're actually capturing most of the upside. So that's where it's like personal choice. And do I want to give up more upside to get more yield? Am I more, give me 12% yield and a little bit of upside lost, or I'm okay with 7, 8% yield, but only a little bit of upside loss. So this is where the income investor now has a lot of choices to choose from, investing in the same asset, but different level of covered call writing, which means different level of how much you're giving up. That's the
Yeah.
gist of it.
Yeah. How do you assess, and should investors assess the downside risk on these different kinds of covered calls if the market uh, really were to, tank?
The way I typically explain it is you're still investing in an S&P or a Nasdaq. If it goes down 10%, 15%, 20%, the covered call ETF will also go down 10%, 15%, 20%. Just like I'm assuming your fixed income closed-end funds, if there's some sort of event that impacts fixed income, they're going to go down 10%. The
Oh, in
key is,
price.
yeah,
Yeah.
and or more if it's leverage. But the key with these, just like your style, is that every month you're still getting paid regardless. So you don't really care. In fact, you're happy if you could buy a little bit more shares. So the same concepts apply. But in terms
Mm-hmm.
of downside, if you're adding covered calls to anything, you automatically have a little bit less risk than the underlying asset, because the downside has to do, or the sorry, risk in general has to do with the downside of something.
Hmm.
So when you're adding covered calls to something, you're automatically cushioning the downside, because covered calls, you're limiting your upside, you're capping your upside for a premium. When there is no upside or a downside, that premium is essentially free money, you could say. So it's a little cushion.
Hmm.
So that's the
Yeah.
general premise of it, but you're still tied to the underlying asset. So if you have a covered call on the S&P, your covered call ETF will do whatever the S&P does. If you have a covered call on a group of 20 tech stocks, same thing. So that's pretty much how it works. Um, so the risk is, I would say,
Yeah.
in summary, a little
Yeah.
bit less than owning the underlying.
Right. Okay. I'd like to just return for a second to one other thing you mentioned, which was that, and I'm the first to admit this, that what I talk about
Yeah,
and write about, call the income factory, is pretty much what a lot of income investors have been doing for years. Certainly, institutional investors, especially, have known how to do credit investing and make equity returns, through the credit markets for generations, because there was no one else competing in that. Retail investors weren't in it. And I think my contribution to this, honestly, has been more in finding a clever way to describe it in a way that lots of
yeah,
people
it
who
is
aren't
hard to
particularly
figure out to
financial,
explain
like
it.
my
Yeah.
own, my wife is not a real financial person, but she's lived with me long enough. She knows about bank loan ratings and all the things I've done. But but she got it immediately. When I came up with the idea of calling it the income factory, I think, and I kind of surprised myself at how much sense it made. But when you think about General Motors or Ford building a factory somewhere, you realize that a week later, nobody in General Motors or Ford even knows or cares what the factory cost, because and because they're not in the business of selling factories. So they're
Reselling the
not,
factory later.
no, that's right.
I
So
get
what
it.
they care about is how many cars, trucks, SUVs the factory produces, and then how do you constantly improve and grow the output of that factory? You buy more machines, this kind of thing. And once I explained that to myself and then started writing about it to others,
Yeah.
it's like, wow, of course, that makes so much sense. And then I realized, and this is what I write about in chapter 2, that gives the whole game away, that if you go back before you were active in this, but there was a time when most of us worked for companies where we'd be with the company long enough that we'd actually get pensions.
Yeah.
It was normal before the rise of 401ks and IRAs. People got pensions from the owner of their company that they worked for,
Yeah.
and that's what you thought about. You thought about how much money am I going to get for the rest of my life. You didn't think about how many assets are there somewhere invested to earn that money to pay me my pension. All
Yeah.
you thought was your pension. But when people when they finally well people started leaving and became more mobile and moved from company to company and wanted to bring their pensions with them, which was hard to do. So they finally started 401ks, and they get rolled into IRAs when you leave a company and all that. But it became obvious that people then were their own pension managers. Once you
Yeah.
took charge of the assets, you had to create your own pension. And this is where, you had the rise of CNBC and Bloomberg and a lot of these media outfits whose job became to train the viewers how to invest their money and to also make a lot of money themselves, because you'd have all these eyeballs on the channel all day long. And if you look at how CNBC covers the markets, you got a bunch of people there all day long going constantly through what's this index selling for, constantly, the same way ESPN covers sports.
To
You
me,
ever
yeah,
look at,
I was gonna say to me it looks like the Weather Channel. Like
or
someone,
that
there's a
too? I mean,
board and
there's always weather somewhere, and
yeah.
there's always sports going on somewhere. So if you watch Weather Channel, ESPN, or now CNBC, you'll always find out whatever's selling, what it's selling for at that moment. But you realize that they have a vested interest in getting retail investors to think about price gain, capital gains and
Quick.
losses and constant movements.
Yeah.
Because if you had a channel that only talked about what you and I do, investing in stuff, and then just
The
letting the
channel
dividends
would go bankrupt in two
in a
seconds,
heartbeat.
one
That's
day.
right. Who would want to watch? It'd be like watching the grass grow.
Yeah, yeah.
There's a
Yeah,
vested interest. The media has a vested interest in not having people be investing the way we do.
yeah,
Uh, and once you realize that, and once our readers and watchers and subscribers know that, then it's like, oh, the light bulb goes off. Like
everyone
I don't
everyone
have to
goes
do
through that light
it.
bulb moment one
Yeah.
way or another because most people start with that single stocks and trying to get in and time the market. So I think I don't know if you would agree with me. I think probably one of the biggest mistakes people make at the beginning when they're starting to invest on their own is they don't know what investing is.
Hmm.
Investing is for the long term, and what they really start with is more or less swing trading, and that's, I have to admit, that's what I started myself. I'm like, saw a company in the news, oh, I'm gonna buy it, and maybe I'll make a quick flip because the company's in trouble or the stock is low, I'll buy it. That's not investing. That's swing trading or trading to make the quick getting in and out, timing, quick bucks. That's all trading, and as you know, it fails for 99% of people anyway. So completely different from investing. Investing is a super long, boring, principled game of patience, discipline, and it's quite safe and boring. But most people, unfortunately, like you said, the light bulb turns on maybe years
Yeah.
later, maybe right away. It depends, right?
Well, yeah, that's what you're describing as gambling for a lot.
It's
Back if you
gambling.
study
Trading
economics,
equals speculating, and which is just a fancy word for gambling, right?
yeah, and if you, I'm a nut about history and economic history and stuff like that, especially. But if you go back into the 20s, before you had an SEC, before you had even a knowledge of Keynesian economics and things, he was in the 20s.
Yeah,
the early, the market crash that then prompted the whole depression, it was essentially people around the country were gambling
Yeah,
and they had no idea what they were kind of betting on or what to expect.
they were
And it was,
borrowing and they were buying
yeah,
anything that they saw,
yeah.
and a lot of people, and it was a bubble. It was a speculation bubble.
But then in the 30s is when you had Benjamin Graham and his buddy Dodd. Graham and Dodd came up with the theory about why you would invest in a company because, well, it's going to grow and you're going to own more and everything.
Yeah,
But then there was another guy. My favorite is a guy named John Burr Williams, who came a few years after them. He was the economist who explained how markets relate to real asset value, and he's the one who explained. And I never went to business school, but if I had, you'd have been in a corporate finance course where they would have talked about him and his theories. He's the one who said that the ultimate value today, right now, of any asset is the net present value of all the future cash payments it's going to create, whether it's a piece of real estate or a stock or whatever going out. And once you realize that the real economic value of something is the amount of cash it's going to produce over its life, and that the market is just a rather imperfect way of trying to capture that. And as today,
yeah,
then you realize, hey, why make the market value the most important thing? Why not go directly to that cash that's the real source of wealth, and just focus on creating that cash for yourself? And boy, once you make that connection, it's
yeah.
like,
So
well,
just
it's a lot
basically,
easier.
it's a long-term game. It's a long-term. It's an investment
Yeah.
for the future for a long time. You could hold it forever, like a piece of real estate. Another analogy you gave, the factory analogy, which
Mhm.
is fantastic. Another one I typically explain, especially to people that are into real estate,
Mhm.
because real estate people that buy apartment buildings and duplexes and
Mhm.
triplexes, they are very attracted to the income style of investing because it's like real estate is really cash flow business. The way I explain it to them, you're buying an S&P either even just without the covered calls, or even you're buying, think of it like you're buying an apartment building. Are you buying it because 6 months later you're going to sell it? No, you're buying it to every month cash flow and collect those rents, and then the piece of property appreciates over time, but you're really focused on buying a quality asset that's going to produce every month. So that's the analogy I typically use. You have the
Mhm.
factory, which is great as well. Eventually you stop really caring what the value of the apartment building is on a day to day,
Mhm.
month to month.
Yeah.
Real estate crashes, the value of your building goes down 10-20%. I don't care as long as I'm getting my rents, and
More
over,
money.
right, it's a long
That's
term
right.
horizon.
And
So
then even at a certain point too, I mean, a lot of people invest in real estate. A lot of retail investor types are afraid of the market. They don't know much about the market, but they'll go out. I know
same.
people, they go out and they buy apartments and things like that, and they bust their, I mean, it's a lot of work
A
to
lot
find
of mental energy, yeah.
and
Whereas, yeah,
when their refrigerator breaks or whatever. And once you take away the cost of owning a building and the anxiety and everything, but you realize what it is the way you just described, then it becomes so much more easy to just say, hey, why don't you REITs and then or
REITs,
fund.
yeah. Oh, you're breaking up there a little bit, Steve. Can you hear me?
I can hear you. Yeah, can you
Okay.
hear me? Oh,
Yeah,
okay, good.
the last part chopped up a bit.
Oh,
Yeah, so we've done an hour, and listen, it's been
yeah,
fantastic. You want to take
good.
like a 5-10 minute break and come back?
Well, I wouldn't. No, I'd just as soon maybe just do another 10 minutes, and then maybe that'll be enough. What do you think?
Yeah, sure. I mean, I do have a couple of questions.
Well, give me. Yeah, why don't you go ahead? Give me your questions, and I'll.
Okay, so next thing. So we talked a lot about the psychology, and I have to say we're literally 100% on the same page. Now I want to discuss a little bit what you invest in, what you like in terms of your investment vehicle. So you seem to like many closed-end funds, right? That invest a lot in fixed income type of stuff. You discussed it on Armchair Income's channel. So what is your attraction to those? Obviously, you come from the debt space. I kind of
Yeah.
understand now why you gravitate towards those. But what do you like about those typically leveraged closed-end funds that typically invest in loans or fixed income?
Okay. I make a distinction between fixed income and credit, only
Okay.
because so many people and people you see on CNBC and elsewhere, they talk about fixed income, but all they really are talking about is treasuries and investment grade corporate debt, all of which usually has longer durations, more interest rate risk, but very little credit risk. So what you're
Yeah,
mostly taking interest rate risk. That your typical fixed income investor is taking interest rate risk,
true.
not being paid much for it, and not really taking much credit risk. I don't like to take interest rate risk. I would rather take real credit risk and then get paid for it. So for me, real credit risk would be it's all corporate debt for the most part, but corporate debt of non-investment grade companies. And you can invest in senior loans, corporate loans, which are secured. That's secured floating rate. So you have no interest rate. It changes over LIBOR, or SOFR is the new LIBOR now. But you get a real spread over that, and it floats and is changed every 3 months. So you're taking real credit risk, but you're being paid for it. And
Hmm.
the same with high yield bonds. High yield bonds tend to be more like 5 years in duration. So there's a little more interest rate risk, but not a lot, because you have 20% of your portfolio coming up for repricing every year, and you're getting real. I mean, you can make 6, 7, 8% spreads over whatever the base rate is, and more for some for high yield bonds. And then you get into CLOs and things that are a little more exotic, where you get paid even more.
So you're
So
saying the risk reward is worth it with
the
these,
risk
you
reward
think?
is worth it in the corporate credit world. And then the other thing, people often who don't know a lot about credit, they'll say, "Oh, well, I could never invest in junk." It's non-investment grade. All the companies that borrow in this, which
Yeah,
means
I hate the
junk.
word that they refer that as junk bonds, but it's
But
really high yield corporate bonds, right?
high yield corporate. But
Yeah.
I don't mind the word as long as I then get a chance to explain what it means to them, because most companies are non-investment grade. Most companies around the
Yeah, of
world,
course.
US, are non-investment grade, including a lot of well-known companies, although
Yeah.
don't ask me off the top of my head to tell you, but there are quite a few. But the average investor, the average equity investor who says, "I'd never touch that stuff, it's so risky," I say, "Well, do you own any mid cap funds or small cap funds?" And they say, "Well, sure, I do. I have a balanced portfolio. I own
Right.
large caps, small caps." I say, "Well, almost all your mid caps and definitely all of your small caps are non-investment grade companies. Those are the same companies whose debt I buy. And
And
you say
typically the debt
you'd never
is less
touch it.
risky than the equity.
Oh my gosh, unless they pay their debt, their equity is worthless. Unless if they don't pay their debt, they'll go out of business. So if I can get paid 9, 10% for just buying their debt, you better be making a whole lot more on your stock
Yeah.
if you're owning the stock of those same companies. So that sort of puts into perspective what we're talking about. And then if you look at, okay, the real risk when you're buying debt or buying credit is defaults. You have a recession. In the normal in what we've had over the last few years, default rates for corporates have only been like about 1%. 1% of all, your whole portfolio might default in a year. And even if we had a recession, when the people who have been predicting the hard landing and the recession have been predicting, oh, we'll have 4%.
Bankruptcies and all this crap. Yeah.
Well, yeah, 4. Well, but in that they would actually have a 4% or maybe 5% default rate. In the worst recession since the Great Depression of 15 years ago, defaults got up as high as about 10 or 11%. But in a garden variety recession, you might have 4%, 5%. Now you've got security, you've got collateral. Even if you don't own a high yield bond, it's unsecured, but they still collect back 40 or 50% of their principal. So if you lost, if you had defaults of 5% and you lost 50% of principal, you'd lose 50% times 5%,
Yeah.
or 2.5% of your portfolio. Well, 2.5% of your portfolio when you're earning 8 or 9 or 10% means it'll cut your income down. It
By a
won't
little,
even
it's very
won't even
negligible. Yeah.
yeah, it won't even touch your principal. So that's the kind of risk we're dealing with when we're in the credit markets. It's so uh, modelable. It's
Yeah.
so easy to project and handle
One,
because
sorry, go ahead.
I
You
like
like
credit
credit? Yeah.
because the kind of you're betting on. I call it, when people go to the racetrack, it'd be like going to a racetrack and just betting on horses to make it around the track without dying. You don't when you're betting on equity, you're betting on a few horses to win or do really well, maybe win, place, or show.
Yeah.
But I can win my bet as long as the horses just make it around the track. So it's a much easier bet to win.
Yeah, I
So
totally
that's what I
understand
like
that.
about yeah, that's what I like about credit.
Yeah.
Now I do like equities, but I like equities like master limited partnerships and
MLPs.
MLPs and utilities, infrastructure of different kinds, where you're more likely to collect 4, 5, 6%, and have less growth. But that's a good trade-off. I'm happy to do that.
Yeah, more
So
more income-oriented equities, which tend to be things like oil and gas companies, infrastructure, utilities, because they tend to have dividends, big dividends
exactly. Oh,
typically. Yeah.
absolutely, because that's what the investors are looking for. Now, why do I like closed-end funds then? See, closed-end funds to me are not an asset class. They're just a vehicle for
Vehicle.
owning different assets. So I
Yeah,
like
that's
different.
exactly.
I like loans and bonds and certain preferred type stocks. But I don't buy the individual ones. I buy them all in a fund because I want a professional who knows a lot more than I do picking the individual loans, bonds. That's why I like to invest through, funds run by the KKRs and the Aries and the Apollos and um, there are a lot of different ones that credit shops, especially that are really, really good.
Yeah,
But
and I mean, I'm gonna put a link in the Seeking Alpha article that you have. You mentioned a few of them there. You talked to another a YouTuber that is also talked about maybe three that you really really like, and
mhm,
maybe we could just review them real quick. If you could see my screen, you talked about XFLT, for example.
excellent.
Uh,
Yeah, they're run by Octagon, who are experts in the whole CLO and senior loan
Senior
market.
loans, yeah, you could see here very high distribution rate.
Mhm.
Right now, it's at a discount actually because the closing price is a bit higher than the NAV here. Sorry, it's at a premium. That's at a small
Yeah,
premium.
but they're not as much. Some of these funds too, you got to take their net asset values with a bit of a grain of salt because they're
Yeah,
owning a lot of not that liquid, you know, not really liquid assets that get priced constantly, which hardly trades at all. So
yeah. Oh, you're breaking up again there, but
uh, closed end, can you hear me?
yeah, you're good.
Okay, closed end funds because they're closed, they're a good way to own less liquid securities where you don't want to have a run on the fund the way if it were an open-ended fund that buys illiquid securities and too many people get scared off by it. We've had open-ended funds crash because not because they were bad funds, they just had less liquid assets. So
Yeah,
so this is a great example of a fund that owns loans and it owns CLO equity
yeah.
and
It's got
stuff like
a, and they're typically very highly leveraged too, I would say, typically in the 30s, 25, 30s. This was 38 on the high side, but I mean,
that.
I don't see
Yeah.
that as an added risk because this is, if you're owning loans and fixed income assets, you're adding some leverage, it makes sense. It raises the risk, of course, of leverage, but it's not like it's a totally crazy risk, right? So how do you
And
feel about a lot of these? Here's another one, ASGI. This is Global Infrastructure from Aberdeen, who's
yeah,
also a big player.
I just bought some of this the other day, bought some more of this the other day because I don't know offhand, they were at a discount. Oh, here it is, 7.5%. That's about, yeah, I think it was at
Yeah,
8%
that's
the
a
other.
discount because then the NAV is
That's right.
higher.
That's right. So I compare this fund to two other real solid ones, the Reeves Utility Fund, UTG,
Hmm.
and the Cohen and Steers Infrastructure Fund, UTF. Now, they've been around a lot longer, those two, and have great records. But because they have great records, they've both been selling more at small premiums. And I mean, everybody seems to hold UTF and UTG as utility infrastructure funds in their long term portfolios. But ASGI currently pays a much higher yield and it sells at a discount.
Yeah,
And so I think it looks pretty attractive. It owns a lot of the same stuff. I'm not I'm not sure, but I think one of the reasons it's also doing well and looks attractive is I believe ASGI is owned in part. I think that the activist fund SABA. Are you familiar with them?
yes.
Yeah, they're one of these funds that goes after other closed-end funds that are selling at discounts and tries to pressure their management to do things that are shareholder friendly. I think I could look it up, but it's Check it out. I think ASGI has, I think SABA came in and bought a piece of them recently. So you know that the activists are trying to, boost it.
Yeah, I think I was just gonna ask you about this later, and what do you think of all-in-one closed-end fund ETFs? And I think one of the most popular ones here is SABA. They have an ETF called CEFs, which is
Yes.
literally the SABA, closed-end fund ETF. And what they do is, and you could see it by the performance, phenomenal performance over the years. And they literally go after, they hunt. My
Yep.
personal opinion of closed-end funds, I think they're the special thing about them is hunting them at discounts because you have
Yes.
open-ended funds don't have that. So you could get 5, 10, 15% discount sometimes. But a wonderful all-in-one solution is an ETF like CEFS, which literally collects or has a bunch of closed-end funds typically.
Hmm.
And here's the one we just looked at. It's right here. And they go after closed-end funds that have big discounts. So you're kind of paying a fee to make them manage a portfolio of closed-end funds. And I'll just open. There's other. There's things like Riv, which is another one. There's an ETF called YYY from Amplify, which kind of do the
Oh
same
yeah.
thing. It's a collection
Hmm.
of 60 closed-end funds, and if you look at the bottom, you could see which ones they have and the percentage. So
Yeah.
Riv, same thing. So my question to you is, why would someone pick and choose their own closed-end funds? Why not just invest in kind of like an all-in-one, which the highest return one would be CFS. Do you
Yeah.
invest in these?
I do.
Okay.
I have, I've kind of move in and out of things in my personal portfolio. There are some closed-end funds that also invest in other closed-end funds.
Yeah, like Riv.
Besides, yeah, besides CEFS, um, which is run by SABA.
Yeah.
SABA took over a closed-end fund and put its own name on it, and it's got the symbol SABA, SABA, and I
Is it an
believe
ETF?
no, I think it's a closed-end fund. In other
Okay.
words, there are closed-end funds that you can buy at discounts and things that do some of the same stuff here. And I've got one, for example. There are two big activist firms. There's SABA, which is run by what's his name? Weinstein. Yeah. Um, and he's got another fund though that's a closed-end fund it's called SABA. Yeah, Capital Income and Opportunities Fund.
Yeah, that's the stock symbol SABA. It looks like it's this. So this is maybe like a closed-end fund version of CEFS of the ETF,
Same
maybe?
idea.
Oh, same
Yeah,
idea.
I think
Okay.
so. If you looked at the holdings wherever they are, you'd see if it owns other closed-end funds.
Yeah,
If you've
I
got a
don't have
list.
the I
Okay,
don't have the web page open here anywhere. Okay, maybe it's this. It's probably
that's all
this
right.
link here.
But
Here it is.
oh,
Portfolio. So here's the portfolio top holding. So you see other. Okay.
they hold all kinds of stuff. Yeah.
Yeah.
Oh, yeah, they're more than just other closed-end funds. And then that same firm, Saba, owns one with the initials BRW.
Yeah.
Um, and they also they're kind of similar to this Saba closed-end fund. But then one I like there's one called it's SPE. It stands for Special Opportunities Fund, I think.
Here's
Yeah, SP,
BRW, the
yeah,
SABA Capital Income and Opportunities Fund, SBI.
yeah. They took that over a couple of years ago, renamed it. It was another fund.
Okay.
And so all of these funds allow you to kind of piggyback on what an activist investor is doing, somebody who really knows the closed-end fund market well
Yeah.
and is involved.
Yeah.
There's another group called let's see, the Bulldog Group. Besides Saba, you got the Bulldog Group, which is
Okay. Never heard of
activists.
them.
They have this fund SPE for special opportunities, and I'm going to look at. They took that over a few years ago, renamed it,
Here it is.
renamed it. Yeah, and it owns a lot of other closed-end funds and a few other things. I'm looking here. Yeah, and it sells, I think, at a discount. Let me just see where they are these days. SPE. Yeah, they're at a 16% discount. SPE, and yeah, I think I bought a little bit more of them the other day. But and they pay a yield. Let's see of
Okay. Formerly insured municipal income fund. Is it from this company? Is it from these guys, Fintel?
yeah, it was a muni fund or something some
Yeah.
years
Yeah.
ago,
Yeah.
but it's been owned by Bulldog and run by them in a whole more aggressive way since then. So yeah, there are a number of these both ETFs and existing closed-end funds that sort of specialize in
Com-
buying other closed-end funds and other things that they think are at, discounts.
So you
So
you
yeah,
you you like those funds because it kind of takes away, just like an index fund takes away stock picking, this is kind of takes away closed end fund picking. That's what I personally like. I like keeping it as simple as possible. So yeah, I
yeah,
would, in case you didn't know, I would check out RIV. It's a
yeah,
closed
River
end.
North.
Yeah, River North. That
Hmm.
hunts closed end funds. They reset their distribution at 12.5% of NAV every year. So you're
Yep.
basically getting 12.5% pretty much yield reset every year. I think it's a good concept, but there's a lot of these. Obviously,
Oh,
CEFs,
that's
very,
right.
very successful,
Hmm.
high returns as well. So, okay, yeah, I mean,
What you might do too is these are more kind of aggressive fun. All the ones you're talking about are run by people who are doing it kind of aggressively, hoping
yeah,
they'll do better than the average and everything.
yeah,
Now, somebody who wants what's been a really solid for years, almost like an index fund of closed-end funds,
yeah.
might want to check out FOF, which is a
FOF?
Cohen. Yeah, it's a Cohen and Steers fund that's been around for years. It pays a nice distribution dividend that hasn't changed for years. But it's been really solid. And I think it's pays probably around 9% now, which is pretty good for somebody who wants to own an entire universe of maybe 100 or so closed-end funds.
Closed
Which,
end opportunity fund, right?
yeah, yeah,
Okay.
yeah,
Yeah, here's another one. So I guess there's a lot more that I didn't know, but I knew about CEFS, YYY, which are
mhm,
ETFs, but then there's RIV. But now there's other closed-end funds that own other closed-end funds as well, like
yeah,
we mentioned. So this is great. I want to thank you for
oh,
making me
sure.
aware of these. And yeah, and like, some of
Well,
them, they're investment vehicles, so they're not necessarily all fixed income. There's some of them that have
oh,
exclusively equity, some have a little bit of
that's right.
everything.
Well, this one I mentioned at the end, FOF.
Yeah, I'm looking at it right here.
Now it's not that attractive right now because it's at a premium of 4%. But if
Okay.
you follow it over the time, there are times when it's at a discount.
Mm-hmm.
And if you buy it when it's at a discount, it's buying other funds, many of which are also at discounts. So you get, if you bought it at an 8% discount and it
Yeah.
bought another fund that was selling at an 8% discount, you get a
Yeah, it's like
total
a
discount
Riv or a YYY. You actually see that
92,
here.
92% of 92%.
Yeah,
If you're getting two 8% discounts, so you end up getting a total discount that's more like 85% or something. So
yeah,
anyway, FOF it's a good one to play the closed-end fund market when markets are kind of down a bit.
yeah. You see that here, right? So you actually get, so the fund itself is 2.93% premium, but the portfolio of closed-end funds inside is at 5% discount. You see
Maybe.
that
I
here,
mean, what you really want is ideally you wait and only buy FOF when it's at a discount,
right?
because then you're buying at a discount and it's buying at a discount. It's like walking in and having double coupons, in the grocery store.
Yeah, yeah, yeah. It's like YYY, same thing. If you look at the bottom, they give you the average discount of the portfolio, which is
Ah,
5.88. So
ah.
it's very important to look at these. The all-in-ones typically give you that stat, and of course, the higher the discount is, the better. I think
Hmm.
Riv is a lot higher actually. Riv is same concept. So Riv is very interesting because it's trading at a discount itself now of
Mm.
2%. But if you look at the fact sheet and look at the overall discount percentage of the portfolio, right here, it's
Hmm.
10.6%. You see the
I
top
see.
funds are some BlackRock ones,
Oh, uh-huh.
Pershing Square, a lot of which is what's his name? This company, I forgot, Bill Ackman's company,
Oh, uh-huh.
Nuveen, BlackRock. Yeah, so very interesting stuff. So
Yeah.
I do find it interesting. I think this is maybe where we're a bit different. You like the closed-end funds. I rather personally just go with an equity, a pure index-based equity with covered calls. I feel like the
Hmm.
this is my personal opinion. Over time, you might get more total return because equities tend to outperform fixed income in general in terms of total return, especially if they start adding leverage ones. I'm very excited about that. But hey, you know, these all have the same type of, it's for income investors. You get paid every month, and that's
Hmm.
really the whole point of these, right? So
Yeah. I mean, and this idea, you only know over decades and generations how much equity actually returns. But if in fact the average equity return for the last 100 years has really been around 9 or 10%, then there are ways, not all, I mean, a lot of people aren't going to want to do risky credit funds and make that much, but there are
Hmm.
plenty of us. I'm prepared to take enough credit risk to probably match that kind of return. Um, but the point is, there's no right or wrong way. Everyone
Yeah,
should do
I agree
whatever
with
they're
that. As
comfortable with. I
we're
like
trying to
your
achieve the
covered
same
call.
thing.
Yeah, I like your covered call approach, and frankly, would like to. I want to learn more about
I'm
that.
open anytime. That's what my channel specializes in. I'm always, and that's what I own myself. I think I would say it's like the next level for income investing, and I think it's only going to get bigger and bigger. But more than happy to chat more about
Great.
these. So you've
Well,
been
this
with
has
us a
been
long
great.
time. I want to take some questions from my
Oh,
community. I think that would be great. And these are
okay,
very, I took the most voted one. So some of them have like
okay,
30, 40,
sure.
50 votes here. So first of all, thank you. This is from Banya from our Facebook group. In your income investing journey, what are some of the mistakes you've made, lessons you've learned? Would you do anything differently if you started with income investing today?
I probably would have started it sooner because I made mistakes myself where I did panic and sold off things that I because I was afraid and ended up with fewer assets
Yeah,
to then go back into the market with. Uh, One thing I learned is during the first sort of Great Recession of 2008, 9, that period, I was still working, collecting a regular paycheck from my, employer. So I looked upon my investments more as something else that I wasn't quite as dependent on then, which made it psychologically easier to just sit through that crash. And, I watched them go down in value, but then I watched them continue to make, take nice dividends in. I wasn't doing strictly income factory yet, but I was kind of edging into it. And I learned a great lesson there that during down periods, one thing we didn't mention is that if you leave your money in to reinvest and everything, not only are we buying funds at cheaper prices, the fund managers, like back then, they were able to buy healthy loans and high yield bonds at 60 cents on the dollar.
yeah.
So they were reinvesting their cash flow at really great prices so that the period after that was a terrific, they had terrific returns for a few years after that. Then I learned by the time the big COVID crash came in the beginning of that, when our government was kind of ignoring the fact there was an epidemic and, that sort of thing. And many of us were really concerned. Is this going to shut down? Are we going to is it going to be another Great Depression or something like that?
Yeah, a
And
lot of
because
fear. Yeah.
and because at that time I was no longer working, I was dependent on my investments. I was probably more stressed out about it than I would have been back in the Great Recession of
Hmm.
10 years earlier. And so I did take some, quote, defensive steps that I really regret now. I wish I hadn't. And I learned a lesson that's, I mean, we don't know what's happening in our country, with this election and what, and all that over the next 6 months. But whatever it is, I'm far more inclined to just sit and assume that we're going to muddle through because I think that's what I've learned from the past that if you, this is what I like about credit, but it's also true of equities.
Yeah.
But the people that run these companies are incredibly compensated and incentivized, even more than they should. I wrote an earlier book on my own called Too Greedy for Adam Smith about 10 years ago.
CEO pay and stuff like that. Yeah, their compensation is very much tied to the stock
Yeah,
prices, right?
because well, CEOs sit on each other's boards, they set each other's pay. It's not the way capitalism's supposed to work. But as a result, even though that happens, the people that run corporate America and corporate Canada and corporate the rest of the world have incredible incentives to just keep their companies alive and to
Hmm.
muddle through no matter what happens. And I think that's an important lesson to keep in mind when we have volatility and craziness in our economic or financial or geopolitical situation that you've got an awful lot of people with far more incentive, far more skin in the game than we have, who are going to bust their whats to keep even if their companies don't thrive and their stock goes to hell,
Survive and wait it
they're
out and
going to
take.
keep their
Yeah.
companies alive. And that's the biggest sort of lesson I've learned, I'd say the hard way and the good way, over the
So in
last over,
summary, hold
yeah.
firm, don't panic sell during bad times, and try to invest more because it's the best time to invest.
Yeah. Yeah.
Yeah. All right.
Anyway.
Next question from Gord Wilson. So this is we kind of discussed about this. This is a very a big debate that you'll see.
Mhm.
Ask him his thoughts on retirement income generation and specifically the debate between only owning growth stocks, which you must sell to generate income, versus passive income investments, which generate regular monthly income through dividends. So we kind of talked about it at the
We did.
beginning. So what would you say about that debate,
And
which I'm sure you've moderated many
well,
times?
I wrote an article for Seeking Alpha that's up now. That's a couple of weeks ago,
Is it the
actually.
one you sent me? Bef-
Yeah, it's the one I sent you.
I'm
Feel
gonna
free
put
to
in the
share
video.
it.
I'm gonna put in the video
Yeah,
description.
yeah. That once you're retired and you have no choice because you got to live to pay yourself a regular pension out of your investments, then it makes a huge difference whether you're in growth stocks or income stocks. Because income assets, they generate that income without, as part of their principal. In other words, if
Yeah.
you had $100,000 and you invested it at 10%, you'd get 10% a year
Yeah.
without ever touching your principal.
Right.
Now, and that means if the market's down and your principal's only worth 80 cents on the dollar, you're still getting what you were getting last year. And to the extent you don't spend it all, if you collect 9 or 10% and you pay yourself 6, you've got 3% left to reinvest at 80 cents
Exactly.
on the dollar. So you're going to come out at the end of that year even better from an income point of view. So I think,
Huge
I
benefit.
what's
Huge
called
difference. Huge
huge difference
difference in
once
drawing
you
down.
retire. Yeah, that's called sequencing risk.
Stephen Bavaria, you've been awesome. You've been with us for over 2 hours. It's been incredible. I really appreciate it. My audience appreciate it. Make sure to purchase his book on Amazon everywhere. I'll put the link in the video description below, guys. I have to say, and I have to admit, we are literally really, really on the same page in pretty much everything when it comes to the psychology of income investing. We've been through it all. I thank you very much. If you guys are interested, there's going to be an exclusive members only video where members have asked Steve questions and they're going to answer those questions as well. So stay tuned for that exclusive video. If you're interested in becoming a member, click on the little join button. Steve, I won't hold you up. Thanks so much for your time and
Well,
hope to talk to you again.
it's been a pleasure. Thank you.
Same here. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the Elite membership. If you're interested in the Elite membership, and even if you want to start out with the free membership and upgrade to the Elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the Elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.